The economy is growing. The stock market is near record highs. Unemployment is relatively low. And according to the official numbers, everything is supposed to be fine. So let me ask you a question. If the economy is doing so well, why does buying groceries feel more painful than it did 3 years ago? Why are more people carrying credit card debt? Why does getting a raise feel like standing still? And why do millions of people feel poorer during an economy that's supposedly thriving? Something doesn't add up, because either the economy is healthy or your wallet is lying. And by the end of this video, you'll understand why only one of those can be true. When economists talk about the economy, they usually talk about three things: GDP, the stock market, and unemployment. And right now, those numbers look surprisingly healthy. GDP is still growing, markets have performed strongly, and unemployment remains relatively low. If you only looked at those three charts, you'd probably conclude that things are going pretty well. But here's the problem. Most people don't live inside charts. They live inside reality, and reality feels very different. Imagine getting a raise. Sounds great, until you realize your rent went up, your insurance went up, your groceries went up, and somehow your bank account still looks exactly the same. This is where many people get confused, because inflation has fallen from its peak, and that's true. But lower inflation doesn't mean lower prices. It just means prices are rising more slowly. The damage already happened. The price increases remain. And that creates a strange situation. The economy can improve while people still feel worse. Because what matters isn't whether prices are rising, it's whether your income is catching up. For millions of households, it isn't. Now here's where the story gets interesting. Because if people were doing fine, you'd expect them to save money. Instead, many are borrowing it. American credit card debt has climbed to record levels, not because everyone suddenly became irresponsible, but because for many households, credit cards became a bridge, a way to close the gap between income and expenses. And here's the dangerous part. That bridge charges interest, a lot of interest, which means people aren't just paying for today's groceries. They're paying for today's groceries plus next year's interest. The longer the gap exists, the harder it becomes to escape. At this point, you might think the problem is inflation, but that's not actually the biggest problem. The biggest problem is something else entirely. We've quietly become two economies. One economy belongs to people who own assets, stocks, businesses, real estate. The other belongs to people who rely mostly on wages. And over the last few years, those two groups have experienced completely different realities. While asset prices surged, the cost of living surged too. The first group got richer, the second group got squeezed. Same country, same economy, completely different experience. And that's why two people can look at the same economic report and come to opposite conclusions. One sees opportunity, the other sees survival. This is the part nobody talks about. Economic statistics are averages, and averages can hide enormous differences. Imagine 10 people in a room. 9 lose $1,000, 1 gains $100,000. On average, the room got richer, but most people got poorer. The same thing can happen across an economy. Strong markets, strong asset growth, strong GDP can coexist with widespread financial stress, which means the official story isn't necessarily false, it's just incomplete. This is why so many people feel like we're in a recession even when economists say we're not, because they're measuring different things. Economists measure economic output. People measure daily life. One looks at GDP, the other looks at grocery bills. One looks at averages, the other looks at reality. And when enough people start feeling pressure, something important happens. They spend less, delay purchases, cancel subscriptions, postpone vacations. And that's when economic pain begins spreading through the system. Not because a recession was officially declared, but because behavior changed. Here's the uncomfortable truth. This doesn't end overnight. Prices aren't likely to return to 2019 levels. The economy won't suddenly reset.
Instead, people adapt. They spend differently, save differently, invest differently, and eventually a new normal emerges. The question isn't whether things will change, they already have. The question is whether you're adjusting fast enough. The people navigating this environment best aren't necessarily the richest. They're the most adaptable. They're reducing expensive debt, building emergency savings, learning new skills, investing consistently, and most importantly, they're paying attention. Because the biggest risk right now isn't a market crash, it's believing everything is normal when it isn't. The economy says you're fine, your wallet disagrees, and for years, many people assumed the wallet was wrong, that people were simply pessimistic, overreacting, being emotional. But maybe the wallet was trying to tell us something. Maybe it was measuring a reality that GDP couldn't see. Because at the end of the day, you don't experience the economy through a government report. You experience it through your rent, your groceries, your savings account, your debt, your paycheck. And if those things feel different than they did a few years ago, you're not imagining it. The economy might look healthy from 30,000 feet, but down on the ground, the view is very different. And understanding that difference may be one of the most important financial skills of the next decade.